Hello and welcome to The Bottom Line on TVP World. This is where we break down some of the main business and economic stories of the day. I'm your host, Marie Cato. Although Hungary's broader reputation isn't so great these days when it comes to attracting Chinese investment, the country is definitely winning the race. According to a new report, Hungary now accounts for almost one-third of Beijing's efforts in Europe, more than Germany, France and the UK combined. Jan Kennedy brings us the details.
China regained its appetite for investment in Europe last year, with FDI rising for the first time since 2016, according to a new report. Although still significantly below the peak levels of the mid-2010s, dominated by mergers and acquisitions, in 2024 Chinese investment in Europe rose to 10 billion euros, driven by a surge in greenfield investment, especially in the electric vehicle sector.
China is trying to have a safer foot on the European market by producing, by at least making some assembling on the market rather than exporting everything, as it was the case before, especially with the United States. This is for the safety of the Chinese investment. And is it going to continue? Yes, in my view, yes, because unfortunately, it seems that the world is in a risk of being more and more protectionists.
Historically, France, Germany and the UK were the top destinations for Chinese investment. Over the past couple of years, China shifted its focus to Hungary, which in 2024 attracted a third of total Chinese investment in Europe. Battery production giant CATL chose the northern Hungarian city of Debrecen as the site for its future €7.5 billion battery plant, the largest ongoing Chinese investment in Europe.
Hungary has managed to build its reputation for China as a country that will be defending its interests in Europe against the other countries. Somehow the record of how Hungary has been defending the Russian interests in Europe can be seen as a proof that Hungary is capable of doing so.
Overall, last year, Central European countries, including Austria, the Czech Republic, Slovakia and Slovenia, as well as Hungary, attracted more than half of the total Chinese investments in Europe. Poland is even home to the third biggest Chinese investment currently in the works, a €1.5 billion EV battery plant. While most experts agree that Poland should aim to attract more Chinese capital, following the Hungarian route is not seen as a suitable option.
Poland probably is not eager to trade off its role in Europe for some Chinese investment. Depending on China, will it be really a necessary precondition for the investment, kind of a guarantee that the country will become the advocate of the Chinese interests or not? We will see.
Poland has already found itself in Beijing's crosshairs, with the Chinese EV giant cancelling production plans in the country after Warsaw backed the EU's tariffs on the import of such cars. Still, as of today, Chinese investment in Europe remains modest, even compared to Japan and South Korea. Although China may have a strong appetite for further expansion, the paper notes a recent slowdown in the EV sector, along with the cancellation of 3 major battery projects, as well as political issues which could threaten further growth.
Hungary's Minister of Trade and Foreign Affairs, Péter Szijjártó, has repeatedly expressed his confidence in Hungarian-Chinese investment cooperation. Today, we want to explore the impact of China's increasing presence in Central and Eastern Europe. What are the reasons behind it, and what does it mean for the future? We're now joined by Max Zenglein, Chief Economist at the Mercator Institute for China Studies, and one of the authors of a new report summarizing Chinese investments in Europe in 2024. Hello, and thank you very much for joining us today.
Good to be on the show. Thank you.
So Hungary has been a top destination for Chinese FDI, a business relationship both countries have tended to for some time now. And Hungary's Trade and Foreign Minister, Péter Szijjártó, has attributed the Hungarian economy's expansion and job creation due to Chinese EV greenfield projects. So what is China's interest behind Hungary and vice versa?
So firstly, it's true that Hungary has been a major destination for particularly EV greenfield related investments. Now, they like to portray this as being some sort of a political feat and a rewarding of Hungarian alignment, maybe with Chinese interests. But I think it's a bit of a more diverse picture. First of all, Hungary is overall a strong destination for automotive-related investments in general. And also, as mentioned in the report, countries like South Korea have a much stronger presence without this being so politicized. So much more, it's a reflection of how China is willing to politicize their investments decisions in Europe. So I think this is also an important lesson to take away from these developments.
But it has to be noted that it's not just Hungary that's attracting more Chinese investments. Last year witnessed a surge in the broader Central and Eastern European region. I just want to bring up a visual, please, where we can clearly see that in 2023, Hungary gets a big share, and in 2024, the whole Central and Eastern European region, including Hungary, gets more than 50% of Chinese FDI. Do you think that this is a one-off, or is this perhaps the beginning of a broader trend, and if so, why?
So I find it's difficult to see wider trends developing at this point because you have relatively low investment levels. I mean, even though we saw an uptick, the overall investment is still 10 billion, which means single deals, depending on the region or industry, can really skew the figures in this case. So, for example, in this year, a major contribution to also Central Europe rising in this case was the largest merger and acquisition happening in Poland with Tencent taking over the gaming company Techland. So this is another contributing factor, but it's difficult to really derive long-term trends here, as there is some volatility based on larger investments.
So you're basically saying that there is an uptick, a significant uptick in the levels of investment, but you're saying that at this level it's hard to attribute any significant trends per se.
So exactly, we're coming from very low levels, and we've seen a decline over the past years. When China had its peak in 2016, when the entire investment volume was 50 billion. So this is a considerable, much lower level compared to these peak levels. And at the moment, we're not seeing a return to these high levels, and hence still very low levels despite the considerable uptick that we've seen in last year's data.
Okay. In your research, you point out China's increased foreign investment in Europe in 2024, as is evident in this visual. Let's bring it up. But before we get into the various details, what lies behind this overall boost? Obviously, you've mentioned that it's not significant enough to attribute any particular trend. It is only 1/5 of that 2016 boost. Here we can see there were levels of M&A. We see levels of greenfield and non-greenfield EVs and non-EV investments. So there is that peak in 2016, and then it dwindles, and now it's going up again. Now it's rebounding. What are your comments in regards to that, aside from the fact that, as you said, it's not as significant really to attribute it to any particular trend, but where is this rebound coming from?
Well, this is the key feature are the structural shifts, and as the chart also indicates, this is a shift away from mergers and acquisition and towards greenfield investments, in particular in EV. So this is really the change in the story of the investment relationship. So this also, if you just recall, a few years back, there was concerns of Chinese companies taking over technology assets in Europe. This is now not so much an issue. It's still an issue, but not as much. And the greenfield investments in general are seen as much more favorable. Now, the key question, also looking in terms of trends, is now after this initial boost of these multi-year projects in greenfield investments in EVs, if this can persist going forward. And we also voiced some concerns that there have already been cancellations of projects going forward. So this is also not a clear pattern if this can continue, and particularly the question would be then in which sector would these greenfield investments then continue to maybe replicate what we've seen in EVs.
I wanted to also ask about the issue of screening Chinese investments. Has the increased level of scrutiny, both the level of scrutiny and the number of reviews, got in the way of EU member states being a Chinese FDI investment? Because there also appears to be a lack of clarity regarding the conclusions in terms of these reviews. The status has been either blocked or pending or uncertain. And what does this essentially mean about these investments? And what does it suggest about the future?
So first of all, this is a reflection of Europe in general trying to increase its investment screening capabilities, which to a large extent are still decided on a member state level. And it also is a reflection on how more complicated relations have gotten. A lot of the times this has to do with also dual use concerns in terms of investments taking place. And it's for me, a reflection of the regulatory maturity in Europe trying to deal with investments from China. However, it's also relevant to point out that Europe remains relatively open and has attracted over half of all the investments going to the developed or advanced economies. So this, I think, reflects that there are still investments possible in China that would not be possible in other countries.
One interesting conclusion from the report is that Chinese greenfield investments mainly focus on EVs or EV-related production, but there seems to be no interest in developing other industries. In other words, if it wasn't for those EV factories, would Chinese greenfield investments be practically non-existent?
Exactly, at least not at this scale. I mean, EVs in automotive-related investments are very capital-intensive, so hence they also reflected in the broader numbers. But exactly that's the case. The question is, in which areas can investment basically replicate what has been achieved at these levels with EVs? There is some thinking about where this could happen, such as in green energy, such as wind turbines or the likes. But so far, we're not seeing any of that materialize. So there's a big question about that. And it also has to do with China itself being more reluctant also to have its technology being basically built up in other countries. So even though Europe has increased its investment screening, for example, China has also become more sensitive in which sectors in technology they want to have being produced in other countries, including in Europe.
Does that mean that China wants European or Western companies to transfer their technology to them?
Well, I mean, this continues to be part of how China treats the investment relationship. But as China has moved up the value chain, China itself is becoming a key technology provider where they are global leaders. And this is not just in EVs or batteries. As I mentioned, this is in areas of green technology. So China's level of sophistication now has put it in itself in a position where it's in China's own interest, trying to basically, to some extent, prevent the mistakes maybe that the West has done or Europe has done in transferring technology to China. And as globalization is becoming more driven by geopolitical constraints, this is certainly something that the leadership in Beijing is being increasingly focused on.
Last year was the year when Chinese EV-related investment grew by more than 50%. But your report points out that a much more significant plunge in new project announcements, almost 80% less than the year before. Can you give us a little insight as to what is happening? Do you think that perhaps Chinese companies respond to weaker than projected demand for electric cars in Europe?
So I think there's a multitude of factors playing into this. Indeed, there is concerns about the investment pipeline coming to Europe when it comes to particular greenfield investments. It's a reflection also of uncertainty about geopolitics, about how trade wars and trade conflicts are going to play out. It also has to do with, as I mentioned, China's own concerns about technology, but also capital leaving the country. And hence, it's a mix of domestic and international factors combined with uncertainty about the global economic outlook that are, I think, attributing to this development.
On the note of geopolitical uncertainty, do you think that Europe should be more open to China, should be more willing to be conciliatory? Do you think that from here onwards there might be a more positive reaction to China that perhaps is a little bit temporary in regards to that broader trade war that Europe is experiencing with the US?
So, I mean, general, I think particularly when it comes to greenfield investments, these should be welcome in Europe. But I think it also needs to be seen in the general context of China's also strategic objectives. And in my opinion, China's relatively open willingness to politicize investments is not a very healthy development. Ideally, these should be based on corporate decisions. There should be an positive economic impact in Europe on this. And it can be, I think, an important element towards rebalancing the economic relationship Europe has with China and basically bring it to a new type of level that is based on mutual benefit. And I do think this increasing politicization puts this positive development at risk.
But when it comes to doing trade with China, there always seems to be some political controversy, which you alluded to. It always weighs heavily. And now with this increased investment on Central and Eastern Europe, now the focus is on this region. Can you give us a little insight on what that might mean for this region?
Well, China will try to play out, have member states competing basically for Chinese investments and try to portray the impression that political alignment with China is rewarded with investments. So I think this is going to, as we're seeing with Hungary in particular, going to foster the competition between countries in Central and Eastern Europe and try to point out to how aligning with China can be positive. So I think this is going to be used up by maybe parts of the political spectrum in these countries to basically showcase the economic rewards that are possible with China if one just takes a more friendly position on China.
And obviously this begs the question, what is China getting out of this increased level of investment in Europe and especially in the Central and Eastern European region? Are we looking at an emerging situation where out of all this economic and geopolitical chaos, perhaps China will end up being an economic winner?
So, I mean, again, here also multiple factors that play into it. It's not just the political reward that is being cherished here. Of course, there's also an economic interest to integrate Chinese players into the German automotive supply to some extent, that where Central Europe plays an important role and in the European context. So by having Chinese battery suppliers in the supply chain, but also having Chinese companies building their own vehicles for the European market in Central Europe. So this is a very important role here as well. So there continue to be economic incentives for companies to be this. But of course, there's also an expectation that China can then leverage this type of investment for political gain. But again, I think it's really important to keep in mind that China remains a minor player, even in Central Europe, and countries, particularly South Korea, are much more important.
And just a bit of a Polish angle as we wrap up. Another area the Chinese are interested in is the broadly defined entertainment sector, as evidenced by Tencent's 1.5 billion euro purchase of the Polish game development studio Techland. Can you give us a little bit of insight into that?
Sure. So there remains a interest by Chinese investments in attractive tech assets. And the gaming one in particular is interesting because this is a sector that the Chinese government has cracked down in the domestic market in China. But there continues to be interest by players like Tencent to secure assets abroad where they can still continue their business interest in this. So in much more, I think it goes to show that Europe and including Poland continue to have very attractive assets for Chinese investors.
Okay, Max Zenglein, Chief Economist at the Mercator Institute for China Studies. Thanks so much for joining us today.
Thanks for having me.
And that concludes The Bottom Line today. I was your host, Marie Cato. We bring you the best of regional business Monday to Friday at 5:10 CT on TVP World. And in the meantime, for the latest in regional business, follow us on X and on tvpworld.com. And for more news and analysis, stay with us on TVP World. Goodbye.